U.S. banks agree to pay $18.5 billion in two settlements relating to the 2008 mortgage crisis, which helped drag the world into recession. But have they got off lightly? You're watching Inside Story Americas from Washington. Hello, I'm Kimberly Helkett. When the U.S. housing bubble collapsed in 2008, millions found their homes were worthless, and some of the country's largest banks had to be bailed out by the government. Well, nearly 5 years later, U.S. banks have agreed to two settlements worth $18.5 billion relating to the mortgage crisis. Bank of America has agreed to pay $10 billion to Fannie Mae to settle claims that the bank sold bad loans to the national mortgage guarantor for 10 years, ending in 2008. And in another settlement, 10 banks and financial institutions, including Bank of America, JPMorgan Chase, and Wells Fargo, have agreed to settle claims of foreclosure abuses for $8.5 billion. Well, about $3.3 billion of that will go to homeowners who lost out in the crisis, and they could receive as much as $125,000. But critics point out that this is not enough to adequately compensate many who lost hundreds of thousands when their homes were foreclosed. Well, indeed, many analysts believe the banks have got off lightly. Al Jazeera's Andy Gallagher has been assessing the impact of the settlement, with one homeowner fighting the foreclosure process in Florida.
Homes in Pompano Beach don't get much more American than this, and Paula Lawler has always been proud of her house. She's raised two children here and wants nothing more than to stay.
Hi. Hi.
But when Paula got sick and missed a mortgage payment, the banks moved in and began the foreclosure process. 5 years later, she's still fighting it and still in limbo.
I have repairs that need to be done. The tile needs to be fixed. The roof has a leak, I guess.
Paula isn't behind on her payments. She's willing and able to keep them up, but says the banks have no interest in taking her money.
And here I am, a single mom, hardworking. Two kids, raising them, and I just want to stay in my house, and just not happening for whatever reason, So sorry I get emotional.
For North America's big banks, Monday's settlement is essentially an admission that they mishandle mortgages on a huge scale, forcing many families out of their homes. People who were unfairly foreclosed on could receive up to $125,000. But critics say the deal allows the banks to escape responsibility for damages that could have cost them much more. And lawyers like James Bonfiglio think the compensation is little more than a token gesture.
It really doesn't do anything because it's not going to stop the foreclosure process. It does nothing to force banks to modify these mortgages. It does nothing to keep people in the houses.
For the banks then, this has been a chance to wash their hands of what's been a messy mortgage crisis and move on. After this announcement was made, shares in many of these institutions rose sharply. But for millions of homeowners still struggling to pay or even modify their mortgages, this represents very little, if any, real help. Andy Gallagher, Al Jazeera, Pompano Beach, Florida.
Well, joining me to discuss the settlements are Matt Stoller, who is a fellow at the Roosevelt Institute and contributing editor to the blog Naked Capitalism. Also in the studio is Mark Calabria, Director of Financial Regulation Studies at the Cato Institute. And from New York, Peter Cardillo is Chief Market Economist at Rockwell Global Capital. Peter, I'd like to start with you. I mean, if the goal of the settlements is to clear up malpractice relating to the mortgage crisis, does this accomplish that goal?
Well, it doesn't really fully accomplish it, but certainly it's a step in the right direction. And, settlements generally put problems behind the industry itself and, of course, of the individuals who have created these problems. Now, I guess the real question here is this a fair amount? Is it too little? Is it too much? And I suspect that the answer lies somewhere in between. No, it's not a lot, and no, it's not too little. So it's a question of putting this problem behind us, and of course, it certainly was a major problem for the economy. The economy was torpedoed by the housing debacle.
Well, let's take a look at some of the numbers that consist of these, what are two deals really. The deal that was announced Monday involved U.S. currency authorities, the Federal Reserve Board, and 10 banks and mortgage servicers. Now, it provides for an $8.5 billion settlement that will be used for cash payments and loan modifications. Now, about 4 million people who were foreclosed upon in 2009 and 2010 are eligible. Those who actually lost their homes will share a pool of $3.3 billion. They'll get cash payments, which range from several $100s to as much as $125,000. Another $5.2 billion will go to loan modifications. The deal ends a probe into foreclosed mortgages, specifically into the practice of robo-signing, which involved the mass processing of foreclosure paperwork, even as the bank was claiming each case was reviewed individually. Now, that pact is separate from the $25 billion settlement that was reached in February between the Justice Department, state attorneys generals, and the 5 largest mortgage servicers. Now, another settlement announced Monday will see Bank of America pay $11.6 billion to Fannie Mae to end a dispute over loans acquired in the 2008 takeover of Countrywide Financial. Well, Matt, when you look at this on face value, it looks like great news for the 4 million Americans who were forced into foreclosure. Is that actually the case?
Well, it's hard to say. Basically, what the settlement is the OCC and the Fed were supposed to investigate what happened with each specific foreclosure, because each specific foreclosure is the removal of someone's home from their I'm sorry, let me start over.
Yeah,
with
sure.
that.
No, it's very complicated. I mean, when you try to, it's small wonder that people had difficulty, signing and understanding a lot of these mortgages, because the devil is in the details a lot of the time.
Well, look, so when you a foreclosure is the back end of a transaction of a mortgage. And what these independent foreclosure reviews, which were going on, were supposed to figure out if anything had gone wrong with any of these particular foreclosures. And what this settlement does is it says, we're just going to stop investigating those. That's what it is. And they said, we're going to pay some cash to some homeowners in a formula we're not going to tell anyone about, and that's it. And if you care about due process, if you care about property rights of the people who were foreclosed on, then you would oppose this, because you would say, well, we need to actually figure out what happened, and then we can figure out what to do about it. And this just says we're never going to know what happened because they're not doing the reviews anymore.
Is that a serious concern? I mean, the fact is that the regulators have sort of stopped regulating and just kind of said, this is too expensive, this is time consuming, we're just going to let the banks handle this.
Absolutely. I kind of think about this, and it might sound a little cliche, but there's the good, the bad, and the ugly. And let me go through really quickly and say, the good here for the banks and I think for the economy is there's some resolution of this. Part of the good is also that instead of spending billions of dollars of fees on consultants, that money will be going instead to consumers, to borrowers. That's a good. The bad, of course, is that there's really no process. There's no triage. Whether you were harmed severely or whether you weren't even harmed at all, if you were foreclosed upon in this category, you will likely be treated the same or very similar. Now, the real ugly of this is something that Matt touched upon, which is, to me, this is not just a dispute between a variety of parties. There's a public policy issue here. And we've seen case after case where, rather than going to court and seeing the arguments presented before the American public, rather than seeing a real detailing of facts of who was harmed, how they were harmed, we've repeatedly seen these backdoor deals cut with the regulators and cut with the banks. And of course, the banks are always going to come from something, and the regulators are always going to say, going to create large numbers. For instance, about 5.5 of this, or rather 5.2 billion of this, can be used for a variety of modifications, including the forgiveness of deficiency judgments, most of which have no value, in which they'll get no money out of. That doesn't mean, of course, the banks in some states don't have a right to come after you, but if you have no assets, the real value of that's very little. So, again, I start from a very basic principle of justice that those who were harmed should be compensated. Those who did the harm should do the compensating. And to me, this deal fails that on a variety of fronts. And that's the real ugly public policy vision of this. Certainly some people will get a nice check and some will get nothing, or they'll get very little. And of course the banks will be able to put them all behind us. I do think it's important to keep in mind that the foreclosure process has been dragged out considerably. So there are some people, Chicago now, the average time to foreclosure is 1,000 days. So there are many people who haven't paid in those 1,000 days, and in my opinion, are not walking away harmed. Whereas there are others that were harmed. So again, to me, we need a process to make sure that people were compensated who were harmed, and that those who weren't harmed are not compensated. And I'll wrap up that with saying an important point that Matt touched upon is, we really do need to know. I have no idea how many people were hurt by robo-signing. We can debate, we can speculate, but because there was really no process, we'll never know. And I think that's an important public policy question for us to know.
And Peter, that's the argument that is often made. This is for the good of the economy. The banks need a point where eventually they can move forward. But doesn't that come on the backs of consumers who have in many cases lost their biggest asset and who will never recover from this, unlike the banks, who will be able to move forward?
Well, obviously, again, if we go back and we can say that we can point the finger not only to the banks, but in some cases even the individuals were responsible for this. And
yet
even
no
though
individuals are standing up. We don't see any individuals going into a courtroom, and I think that's one of the big criticisms, that there need to be some individuals on Wall Street who need to be held accountable.
Well, obviously, unfortunately, the system is geared to light punishments, in the sense that if we look throughout the years, how many scandals did we have? How many people broke the law? And how many people really wound up in jail? Just very few. And in this particular case, probably no one within the banking industry is really going to pay for this in terms of a jail sentence. But again, I go back to the basic that we need to put this behind us, and we need to get the economy moving forward. And I think once we do this, even though the settlement may not be fair, I think it's one step forward, one less problem for the industry. And
but what about the consumers? I mean, if the consumers
activity.
were compensated fairly, wouldn't that get the economy moving forward too? People would be spending money again. They would be buying cars. They would be making big investments. It seems that argument tends to be a default setting, that we must prop up the banks in order to get the economy moving forward.
No, I mean, I guess I'd say, I don't find the economic argument really on either side that compelling. I mean, I do believe that we've dragged out the foreclosure process in a way, by and large, not in individual cases, because again, part of the problem with this is it's been a very broad brush. It's been, okay, you were foreclosed in this time. There's no real, investigation of whether were you harmed, were you not harmed. If you were harmed, you should be compensated. It's not really a question of whether you're going to go out and spend that money and spur the economy. It's a question of justice. Because ultimately, even if you were harmed and you were entitled to that, that money's going to come from somebody else who's not going to spend it. So the macroeconomic effect is zero. So, we're not going to get a spending side on whether someone was harmed or not. This really is about how do you get appropriate behavior in the future as well. How do you make sure you get the incentives, whether it's the CEO or whether it's the loan officer or whether it's the person, signing the foreclosure documents. And this is one of the things that drives me crazy on this, is that even the numbers we're seeing, shareholders are paying that. It's not the executives. It's not anybody who actually committed any harm. Now, of course, if you invest in a company that ends up having bad practices, you will suffer as a shareholder, as you should. And so I don't want to say that shareholders are completely blameless. But at the end of the day, what you have is regulators at the table sitting across from bank executives. The bank executives, none of this money is going to come out of their pocket. The bank regulators, they're looking at this and saying, we need to put this behind us. We, of course, need the appearance of we're doing something, so we'll come up with very large numbers that people will be oohed and awed about, and then we'll move forward. But again, there's very little attempt here to right individual wrongs.
And isn't that a problem, Matt, given the fact that the regulators are in most cases, their salaries are paid for by the taxpayers that are not being protected and are not being given the careful oversight. I mean, in one of these settlements with Bank of America, the $3.3 billion, or which the 10 banks actually are paying out, many will see just $125,000 if they're lucky. Now, there aren't many homes in the United States for $125,000. That means a lot of
Actually,
people.
A lot. You'd be surprised here in Washington.
That's not real money either. I mean, to be when you forgive a deficiency judgment, that might be technically $200,000 or whatever it is, but it's not actually real.
Some will actually receive just a couple $100s.
Yeah, I mean,
I think the point I'm trying to make, my math may be off, but the point is, drop in the ocean.
This is part of a policy architecture of the last 5 years that says something very simple. Crime pays. And that's the lesson here. If you are a banker and at an institution that is too big to fail, and you break the law, you're going to profit from it. And fundamentally, we have sent people to jail because our system isn't sustainable without some element of justice in there. During the savings and loan crisis, George H.W. Bush, under his administration, they sent 3,000 executives to jail. 1,000 of them were high-level white-collar executives. It's not that it's not possible to do this. It's a policy choice to forgive high-level executives for committing what are very obviously crimes.
Well, and I want to make another, to tie that to the question earlier about the economy. I mean, what hurts the economy is when you do have the shareholders pay that, because you're reducing the capital of the bank, you reduce upon which they're lending. So that shrinks the economy. But having executives who committed wrongs, who in those cases should not be in the bank, for that person to go to jail, that's not an impact on the economy. So in a sense, we were doing this backwards. We would be out of this crisis quicker.
It's not even the shareholder paying. I mean, these shareholders wouldn't have anything if the public hadn't bailed out these banks.
I mean, in some cases.
It's not. I mean, what this is this is a transfer of power and wealth to people in a protected class. I mean, just to give you an example of what I mean, a very simple law. There is a law that says that you're not allowed to foreclose on active duty troops. You just can't do it. And it's a misdemeanor, but it carries, it's got teeth, it carries a year in jail. J.P. Morgan went before the Veterans Committee in the House and said, we've done this, we violated this law a lot, we're really sorry. And regulators later found that this law was violated something on the order of 5,000 times. And the Department of Justice came to a resolution with a bunch of the banks, and the banks didn't have to admit or deny any violations. There was no prosecutions, and the defendants, or the homeowners, the lawyers of those homeowners were saying, we need to send some of these people to jail, so they stopped doing this. And of course that didn't happen because it's a policy choice to do this. In earlier periods, we've made different policy choices. It's not like this is impossible to solve. We know how to solve this stuff. When somebody does something wrong, you prosecute them for it if they've broken the law. And that's just what the DOJ isn't doing that.
Yeah. Peter?
May I inject this thought? What you're saying is correct. But
thank you.
Let's go back. Let's go back and let's look at the housing crises that began and created a bubble. Don't you think that many individuals who bought homes, who actually committed fraud, are a part of this?
I don't.
Why should they be rewarded?
You know why? Because there was a.
Why don't you? Why don't you?
Because this was. Are you going to let? This was driven by the capital markets. There was a whole segment of loans called.
Wait a minute. Driven by the capital markets. But let's not forget. Let's not forget that also you had individuals that were actually committing fraud by lying on their applications that they were, able to make mortgage payments and making all kinds of money, which really never existed. I had a client who bought a $1 million home up in Boston and was making $60,000 a year. Well, how do you support that?
But whose fault is that?
I want to respond to that.
There's supposed to be some due diligence when conducting one of these loans.
Of course there is. There was an industry segment, a profitable industry segment called liar's loans. It was called liar's loans. This is what was, it was known in the industry that people were committing fraud. Ninja loans, which were no income, what was it? No income, no assets, no jobs. I mean, the banks were lending this to people, lending this money, and they were saying, sign on the dotted line, don't worry, this is all fine. In some cases, they would make threats to people saying, you've already committed to this. I dealt with homeowners who were told, here, we'll offer you a 30-year fixed plain vanilla mortgage, and then when they got there, they said, here's a mortgage, we're not even gonna let you see it, and if you don't sign it, then we're going to sue you. I mean, this was a really, this was a toxic industry segment.
No,
it's not. It's not a mistakes on both sides. This was a bubble that was driven by the capital markets, by the need for for Wall Street banks to securitize as many loans as they could because they were making fees and it was a volume business. And so a lot of the origination was done. It was done poorly. It was done with sloppy paperwork. It screwed the investors who bought it. And it was driven by the capital markets. It's not to say that people didn't commit fraud when they borrowed money, but many of them didn't. Most people, they buy 1 or 2 houses in their homes and they don't actually know how to do it, and they trust the entities that they're dealing with to tell them how to do it. And if somebody says, oh, that line about your income doesn't matter, they're going to believe them.
So Mark,
if I can parse out a few parts of this.
I'll let Mark jump in here just to give him a turn.
And let me start by saying I very much think the bubble was driven by macroeconomic policy first and foremost. I mean, you don't have the Federal Reserve keep interest rates negative for 3 years without something bad happening. And of course, there are other policies that get there. And so I think I take a position a little way halfway between this and that. There were very bad incentives created by the system. Bad incentives for borrowers, bad incentives for lenders, bad incentives for regulators. Now, it's also important to keep in mind that not everybody responded to those incentives the same way. Wells Fargo did not behave in the same way as Countrywide. Goldman, for their problems, did not behave in the same way as Bear Stearns. So I do think there's an extent to which people are blameless because they were facing bad incentives, but there's an extent to which they bear some blame because they were facing, because
and isn't there also some blame on the part of the regulators because of this lack of uniformity? One more point I want to raise here is this sort of regulation of settlements. Does that need to be something that needs to take place as well? And let me point to you, because we talked about that $25 billion mortgage settlement from earlier this year. Now, it's been reported that only half of that has actually gone to the housing-related programs that it was intended to go to, and that some of the states have actually used some of this money. So again, even when you get a settlement, it doesn't guarantee it's going to the people that may be intended. It seems that this is a problem. It's almost like a broken record.
Absolutely. I mean, I see this as kind of a repeat. I mean, let's first start, if you go back and look at the earlier settlement, twice as much money went to state governments as went to homeowners who were foreclosed upon. So it was clear here.
And that was certainly not the spirit of the settlement.
No, it was not. It was clear, in my opinion, who the attorney generals were looking out for. And then once that money got to the states, as you touched upon, several states have spent it on, things absolutely non-house related. It actually makes me think, if you go back 20 years or so to the tobacco settlement, where all that money was supposed to go to health care, how much of it actually ended up there? It went to so many other things. So again, you've seen this diversion of the funds away from, and I go back to my first principle, the money here should be going to those who were actually harmed. Matt and I might disagree about some categories of who were harmed, but I do think the point should be we should be helping those who were harmed. And again, it should be those who did that.
And only a couple of minutes left. I want to make sure that we get these final points out, because there are a fresh torrent of lawsuits that are still being filed to many of the big banks. I mean, does that mean that there needs to be more of a regulation of the process? Peter, I'll get you to comment on that quickly, and then we'll get you to finish up.
Well, I think, it boils down to one thing, that the regulators need to make sure that things go smoothly. And, it goes back to what I said a few moments ago, that everyone enjoyed the rise in housing prices. Everyone participated, almost everyone. And, the regulators were sleeping at the wheel. So everyone is to blame. And I think we need to see the regulators really clamp down, in the sense that they need to be more involved.
Matt, is that a point? I think you can probably agree that the regulators were asleep at the switch.
Well, I think the regulators are just corrupt, and I don't actually think that everyone was to blame. I think that that's a way of saying no one is to blame. This is a question of justice. American homeowners lost $5 to $7 trillion in the largest heist in American history. That's what the bailouts and the housing bubble were really about. And what you find now is that inequality is at a record high. And if everybody had lost equally, inequality wouldn't be at a record high, but it is. And what you're going to find, and we've already started to see it, is this social contract is fraying. You're going to see more protests, you're going to see more social disorder, because fundamentally when people feel like they have less and less of a stake in their society, they begin to rebel against the institutions that control and govern that society. And that's what we're seeing.
All right, we certainly will be following this as it continues to unfold. It's certainly not over yet, gentlemen. Thank you. I'm going to have to leave it there. We are out of time. That is all from the team in Washington, D.C. for now. Want to remind you, don't forget to follow us on Twitter and Facebook. That's where you'll find more information about our program. And we want to hear from you. Tell us what stories you think we should be covering. send your ideas directly to us here, Inside Story, at aljazeera.net. Thanks for watching Inside Story America.